there has been a prolonged urban slowdown, and that is actually prompting, FMCG makers of daily essentials to roll out smaller, lower priced packs of premium products. And this they are doing only to boost the demand across categories from soaps, shampoos, snacks and frozen foods. In fact, what's interesting to see is that all of these small packs are only volume drivers. The value actually comes in from bigger packs. The key question over here is going to be, if this is the strategy that they are going to adopt, how big an impact will it be on their margins? But first, let me head across to Sesa with more details on the same. Sesa, over to you.
The prolonged slowdown in urban consumption is posing a unique challenge to FMCG companies as their premium consumer base shrinks. Now, while consumers mainly in cities are still purchasing premium products, they are opting for smaller versions of such products to manage their budgets amid inflation. Now, HUL has recently highlighted that this shift to smaller packs is a trend breaker, something that they did not observe even in the previous quarter. The company considered a barometer of FMCG consumption, stated that this behavior is offsetting the typical uplift that companies experience when premium products grow faster than rest of the business. Like HUL, several other companies such as Godrej Consumer, Colgate, ITC and Britannia have rolled out mini packs of their premium offerings to boost demand. However, with urban demand showing no signs of improvement and large packs continuing to grow at a slower pace, companies risk a delay in their growth revival.
Okay, so urban consumption, clearly we are looking at a slowdown as per what the HUL commentary also was like. But let's look at some other stocks as well, which are in focus on the back of the revision in the FY25 guidance. The first one being Elecon Engineering. The stock is down today after the company revised its revenue guidance of 15%, saying that it may miss this by 3% or so in FY25. However, they've maintained the EBITDA margins of 24% despite the revised guidance of 12% that we are looking at. The revision is mainly on the account of challenges they're seeing in the macro picture and in some other sectors as well. Order inflows are also delayed in division due to the external macroeconomic challenges which are taking place. Now, coming to Syngene International, this is another stock in focus. We talked about the earnings picture, but let's look at the revenue guidance. Now, they've lowered their FY25 revenue guidance to single digit growth with flat profit expecting. Now, the company was expecting this high single digit to low double digit growth in FY25, but due to the demand, due to the 8 to 12 week delay in demand recovery in US biotech funding, the Q3 was impacted. So Syngene International also looking at the cuts of around 3-4% in trade, looking at the cuts of 6% in trade today. And lastly, we have Amber Enterprises, which came with a very good set of numbers. In fact, the company also revised the revenue growth guidance to 55% from 45%, with the intention of maintaining this guidance of doubling revenue in the railway and defense segment.